There's a reason the wealth gap keeps growing, and it's not what they tell you. It's not education. It's not work ethic. It's not even capital, because plenty of wealthy people started with nothing. It's this. The people at the top of the wealth pyramid are operating with a fundamentally different quality of information than everyone else. Not secret information, not insider trading, public information, processed, analyzed, and acted on in a way that is so far beyond what a normal investor can do manually that it might as well be secret. And for the last decade, the tool that made this possible was only accessible to hedge funds, family offices, and institutional investors with technology budgets in the millions. That changed, and the people who figured it out first are already compounding returns that most investors will never see. Today I'm going to show you exactly what this is, exactly how it works, and exactly how to access it. Because the window, where this is still an advantage, is not going to stay open forever. I want to start with a question. Have you ever noticed how institutional investors, the big funds, the family offices, the serious money, seem to move before the news? Not every time, but often enough that it feels like a pattern. A stock starts moving 2 days before an earnings report. A sector rotates before the macro data confirms it. A position gets built quietly over weeks before the catalyst that sends it up 30% becomes obvious to everyone else. Most people look at that and assume it's insider trading, corruption, the system being rigged. Sometimes it is, but most of the time, and this is the part that should genuinely change how you think about markets, most of the time, it's something completely legal. It's information arbitrage, and AI just made it available to anyone with a laptop and the patience to set it up correctly. What I'm about to walk you through is not a trading strategy in the traditional sense. It's not a set of buy signals or technical indicators or chart patterns. It's a framework, a systematic way of seeing information that is already publicly available but functionally invisible to most investors because of the sheer volume of it. The wealthy aren't seeing different information. They're seeing the same information differently. And that difference is worth an enormous amount of money. Part 1. The problem with how most investors consume information. Let me paint you a picture of how most retail investors, including, honestly, the version of me from a few years ago, process information. You read an article, maybe a few. You check your portfolio. You see a headline that makes you nervous, and you either do something about it or you don't. You maybe watch a YouTube video, possibly this one, and you form a view. That's it. That's the information processing system that most individual investors are running. Now, let me show you what's happening on the other side of this trade. A mid-sized hedge fund, nothing enormous, maybe $500 million in assets, that has systems running right now that are simultaneously processing earnings call transcripts going back 5 years across hundreds of companies, analyzing not just what was said, but how it was said and how the language has shifted quarter over quarter. CC filings, all of them, in real time, flagging anomalies in accounting language, changes in risk factor disclosures, shifts in how management describes their competitive position, patent filings, job postings, satellite imagery of retail parking lots and shipping container traffic, web traffic data, credit card transaction aggregates, supply chain announcements from suppliers, 3 levels removed from the company. They're actually interested in social media sentiment, not just volume, but the specific language, patterns of people who actually use a product versus people who've just heard about it. All of this simultaneously, every day. Now, here's the uncomfortable question. When that fund and you are trading the same stock, who has the edge? The answer is so obvious, it almost doesn't need saying. But here's what does need saying. Until about 3 years ago, there was genuinely nothing you could do about it. The technology required to process information at that scale cost millions of dollars and required teams of data, scientists and engineers to build and maintain. It was a structural advantage that money could buy and individuals couldn't replicate. beat. That's not true anymore. And the people who realized it first, the early adopters who figured out how to point modern AI at the same type of information that institutional players use, have been quietly compounding an information edge that, until recently, was impossible to access. Part 2. The mechanism. Let me give this a name so we can talk about it precisely. What I'm describing is AI-augmented information arbitrage. Arbitrage, in the traditional sense, means exploiting a price difference between two markets. You buy where something is cheap and sell where it's expensive. The profit is in the gap. Information arbitrage is the same concept. But instead of a price gap, you're exploiting an information processing gap. The asset is priced based on what the market collectively knows and believes about it right now. But the asset's true value is based on information that exists, or that is publicly available, but that the market hasn't fully processed yet. The gap between those two things is where the opportunity lives. Now here's where AI enters. The reason this gap existed and was only exploitable by institutions is that processing that volume of information manually is impossible for a single person. By the time you read through one company's SEC filings, 10 more have been released. By the time you finish an earnings transcript, 3 more have dropped. The information advantage was a throughput problem. AI solves throughput problems. A well-configured AI system can process in an hour what would take a team of analysts weeks. It doesn't get tired. It doesn't miss things because it's bored or distracted. It doesn't anchor to prior beliefs. It just processes. And when you point that processing power at the right information, the same information institutions use, you start to see things that the market hasn't priced in yet. I want to give you a concrete example, so this stops being abstract. Part 3. The concrete example. Earlier this year, I was running my AI system across a set of mid-cap technology companies, and it flagged something in the earnings. Call transcripts from one particular company. Nothing dramatic. No smoking gun. Just a pattern. Over 3 consecutive quarters, the CFO's language when discussing cash flow had shifted. Subtle changes. The kind of thing you would never catch reading one transcript. But when you read all 3 in sequence, with an AI, highlighting the linguistic delta between each one, a picture emerged. The confident, forward-looking language about cash generation from 12 months ago had gradually, incrementally been replaced by language that was more qualified, more hedged, more focused on managing cash rather than generating it. No analyst had written about it. The stock had actually been performing well. There was momentum behind it. 3 weeks later, the company revised its cash flow guidance downward significantly. The stock dropped 22% in 2 days. Now, I want to be very clear about something. I am not telling you this to imply I have a crystal ball or that AI is infallible. It is not. What I am telling you is that the signal was there, in publicly available documents, visible to anyone who processed them correctly. The market didn't see it because nobody, no individual investor, no small fund, nobody without institutional grade text analysis infrastructure was reading those 3 transcripts together in sequence with the right analytical framework. Until AI made that possible for anyone. That's information arbitrage. And that's what the wealthy have been running. In various forms, at various levels of sophistication, for years. Part 4. The 4 pillars. Let me now break down the actual strategy into its 4 components, because this is where it goes from concept to something you can actually use. Pillar 1. Earnings call language analysis. Every public company holds an earnings call every quarter. The transcripts are freely available, and the language in those transcripts, analyzed over time, across multiple quarters, contains more predictive information than most investors realize. What you're looking for is not what was said, it's what changed. Management teams are coached to be careful with their language. They don't accidentally say concerning things, which means when the language shifts, when optimism becomes caution, when specificity becomes vagueness, it's a signal worth paying attention to. An AI configured for linguistic pattern recognition. can process years of transcripts for hundreds of companies and surface those shifts in minutes. Pillar 2. Regulatory Filing Intelligence. SEC filings are the most information-dense documents in public finance, and almost nobody reads them fully. The 10K, the 10Q, the 8K, filings when something material happens. Proxy statements. These documents are required by law to disclose risks, related party transactions, executive compensation structures, and forward-looking statements. They're also written in dense legalese that is genuinely difficult to parse at scale. AI reads them completely, every time, in seconds, and it knows what changed from the previous filing, because it has all the previous filings to compare against. A risk factor that appears for the first time in a 10K is worth knowing about. A change in how management describes their competitive moat is worth knowing about. A related party transaction that wasn't there 6 months ago is very much worth knowing about. This is the kind of analysis that, in a large fund, a team of junior analysts would spend weeks on. You can now do it in an afternoon for every company on your watch list. Pillar 3. Supply chain signal mapping. This one is slightly more advanced, but it's also where some of the most actionable signals live. Every major company exists within an ecosystem of suppliers, customers, and partners. And those adjacent companies often report before the main company does, giving you a forward view on the main company's health before the market prices it in. If a semiconductor supplier reports unexpectedly weak demand, that's a signal about every company that uses that semiconductor. If a major retailer's supplier inventory levels spike, that's a signal about consumer demand before the retailer reports. The wealthy have entire systems dedicated to mapping these relationships and tracking them in real time. With AI, you can build a simplified version of this, identifying the key supply chain relationships for companies you're following and monitoring those adjacent signals systematically. Pillar 4. Sentiment velocity tracking. The fourth pillar is about speed, not accuracy. Markets move on the rate of change in sentiment, not just the level. A company that everyone hated 2 months ago, but is now being discussed more positively, is in a very different position than a company everyone loves, but where enthusiasm is quietly fading. Traditional sentiment analysis tries to tell you whether sentiment is positive or negative. What actually matters, and what AI can track with precision, is whether sentiment is accelerating or decelerating. The direction of the trend and how people are talking about something. That velocity signal, combined with the fundamental signals from the first 3 pillars, creates a picture that is genuinely difficult to see any other way. 4 pillars, 4 information streams, each one individually useful. Together, pointing at the same company at the same time, they create a signal quality that was, until recently, exclusive to people with institutional resources. I want to stop here for a second, because I can feel the question forming. This sounds like a lot. Is this actually something I can do? Or is this still just for people with resources I don't have? It's a fair question, and I want to answer it honestly. 3 years ago, this was still out of reach for most individual investors. The tools existed, but they were expensive, technically complex, and required meaningful expertise to configure correctly. That is genuinely no longer true. The AI tools available today, many of them at low or no cost, are capable of performing every single one of these 4 functions. The barrier isn't technology anymore. It's not money. The barrier is knowing that this approach exists and being willing to spend a few hours setting it up, which is why this video exists. But I also want to be honest about something else. This edge, like every edge, has a shelf life. Right now, the number of retail investors running any version of this system is small enough that the information gap is still meaningful. The market hasn't priced in the fact that individuals can now process information at institutional speed. That window will close. Not tomorrow, but it will close. The investors who build this system now are building a habit, a skill, and an edge that will compound over years. The ones who wait until it's mainstream will find the advantage has already been arbitraged away. I'm not saying this to create urgency for its own sake. I'm saying it because it's true, and because the most consistent theme in the history of every technological advantage in investing is that early adopters win enormously, and latecomers arrive at a party that's already winding down. Part 5. What this actually looks like. Let me show you what a basic version of this system looks like in practice, because I think seeing it is more useful than hearing me describe it. I'm going to walk you through a real session, a real company, real public documents, and I'll show you the type of signal this approach surfaces. I'm not going to tell you to buy or sell anything. That's not what this is about. What I want you to see is the quality of information that becomes visible when you apply this framework. I've pulled up the last 3 earnings, call transcripts for a company I've been watching. Doesn't matter which one for the purposes of this demonstration. The process is identical for any public company. I'm going to feed these into the AI with a specific analytical framework. Not just summarize this, but a structured prompt that asks for specific things. Changes in language around key financial metrics. Shifts in how management describes competitive dynamics. Alterations in forward guidance language. Any new qualifications or hedges that weren't present in previous quarters. Here, 3 specific language shifts flagged. 2 of them are relatively minor. Normal evolution in how a company talks about its market. But one of them is notable. The phrase the CFO uses to describe pricing power has changed in a very specific way. In the previous 2 calls, they described pricing power as durable. In the most recent call, that word is gone, replaced with appropriate for current market conditions. That's not an accident. Durable implies permanence. Appropriate for current market conditions implies dependence on conditions that could change. Is this a screaming sell signal? No. Is it something that justifies a closer look at the next earnings report? Absolutely. And here's the thing, that shift is in a publicly available document. It's been there since the transcript was published. Every investor who follows this company theoretically had access to this signal, but nobody's reading 3 consecutive transcripts with linguistic pattern recognition unless they have a system for it. Now you do. Part 6. The objection. I know what some of you are thinking. If this works, why doesn't everyone do it? Why isn't this already priced in? It's the right question. And the honest answer has 2 parts. Part 1. Some of it already is priced in at the institutional level. The largest funds have been running versions of this for years, which is precisely why the market has become harder to beat with traditional analysis. The low-hanging fruit of fundamental research was picked long ago by people with better tools. What's not fully priced in is the retail layer. The information gap between what institutional investors can process and what individual investors can process has been enormous for decades, and it's only recently started to close. The market hasn't caught up to the fact that retail investors now have access to institutional-grade information processing. Part 2. Setup friction. Most people, even after watching a video like this one, will not build the system, not because they can't, because the gap between understanding something and actually implementing it is where most human ambition goes to die. The people who do it, who sit down this week, build the system, test it, refine it, those people will have a genuine edge for a meaningful period of time. The people who think that's interesting, I should do that someday, will eventually find themselves on the wrong side of another information gap they didn't know existed until it was too later. I'm not judging. I've been the person who understood something and didn't act on it. It's one of the most expensive mistakes an investor can make. And the cost is invisible because you never see the returns you didn't capture. I want to close the main content of this video with the insight that, for me personally, reframed everything. When I first started researching how wealthy investors, real ones, not the ones on social media, actually make their decisions, I expected to find something exotic, some proprietary model, some secret asset class, some connection or relationship that gave them access to things the rest of us couldn't touch. What I found instead was, at its core, incredibly simple. They're not smarter, they're not luckier, they're more systematic about information. They've built processes, some manual, increasingly automated, that ensure they see more of what's already there than their competitors, and they act on it faster with less emotional interference. That's it. The entire wealth advantage of sophisticated institutional investors, reduced to its simplest form, is they have a better information processing system. And for the first time in history, you can build a version of that system for the cost of a few software subscriptions and a few hours of your time. The game hasn't changed. The access to the tools needed to play it well, that's what changed. And what you do with that information is entirely up to you. But I promise you this, 5 years from now, looking back at 2026, the investors who figured this out early and built the discipline to use it consistently, they're going to be in a very different financial position than the ones who didn't. Not because AI is magic, because information, processed correctly and acted on consistently, has always been the only real edge in investing. AI just made that edge democratized for the first time. Let me bring this together. The wealthy aren't using a secret, they're using a system built on 4 pillars: earnings language analysis, regulatory filing intelligence, supply chain signal mapping, and sentiment velocity tracking. Each pillar alone is useful. Together, they create a quality of market visibility that was structurally impossible for individual investors to replicate until AI made it accessible. The strategy is legal. The information is public. The tools are available. The only thing standing between you and the same information, edge that institutional money has operated with for years, is the decision to build it. If this video changed the way you think about information and investing, hit subscribe right now. Drop a comment with the word insider if you're ready to build this system. I want to see how many people in this community share this with someone who talks about investing, not because the algorithm needs it. The window's open. Let's use it.